Something just feels wrong with the market. We've had 3 straight years of these historic gains, right? A relentless climb that, well, it just defies logic. But if you look just beneath the surface, the whole structure is rotting. Get this. The entire US stock market is now valued at over 220% of the nation's GDP. Now, let me be clear. Every single time we've hit these kinds of altitudes before, the story has ended badly. Really badly. So this isn't just a rally, it's a bubble, and it's just searching for a pin.
But here's the thing, this prosperity, it's a total mirage. Since late 2022, pretty much all the market's gains have come from just a handful of giants, the ones riding that massive AI wave. So what about the other 493 companies in the S&P 500? They've gone absolutely nowhere. Flat. This is not a healthy market, folks. It's more like a life raft being held afloat by just 7 swimmers.
And that level of concentration, well, that's a classic late cycle warning sign. I mean, think about it. When just a few stocks have that much gravity, they don't just lead the market up on the good days. No, they can drag the entire system down with them when things go south. We saw this play out in 2000.
So that brings us to the central mystery, doesn't it? We have all these warning lights flashing bright red, you've got extreme valuations, historic concentration, and yet nobody seems to be worried. Why is that?
Okay, so this here is the VIX. It's what Wall Street calls its fear gauge. And right now, it's trading near its lowest levels of the entire year. Let that sink in. The market is basically pricing in absolute calm. At the exact moment, it should be pricing in chaos.
You're not going to find the answers in the headlines. They're buried much deeper, in the data and the capital flows that actually move the markets before the news breaks. And this channel, well, it exists to track those very shifts before they become obvious to everyone else. So let's dig into the evidence. All right, clue number 1. It lies deep within the internal structure of the US market itself. You could say the crown is heavy, sure, but it's also incredibly hollow. Just 10 companies. That's it. 10 companies now make up over 40% of the S&P 500's entire value. I mean, just stop and think about that for a second. The financial fate of the biggest economy on the planet, and yeah, probably your own retirement account, is resting on the performance of just 10 corporate boards. The risk isn't diversified anymore. It's dangerously, dangerously amplified. And if you want to understand the sheer scale of this distortion, just consider this one fact. One company, Nvidia, right? Fueled by this AI frenzy, its market cap now rivals the entire annual economic output of Germany, the whole country. When a single stock becomes an economy unto itself, that creates a systemic risk that I guarantee you nobody is pricing in correctly. But look, this isn't just a market problem. Not at all. It's a political one too. And there's a predictable, totally self-inflicted wound headed our way, straight from Washington, D.C. So, at the end of January, that temporary government funding deal, it expires. And that means another shutdown is squarely on the table. And let's not forget, we just went through the longest shutdown in US history, an event that completely froze critical economic data and sent millions of federal workers home without a paycheck. The market is acting like this can't happen again. And listen, this isn't some abstract threat off in the distance. The Atlanta Fed's own real-time GDP model, it's already pricing in the damage. It's forecasting significantly weaker growth than what everyone else is saying. This political gridlock, it's a measurable drag on the economy. It's like sand in the gears of American growth. And yet, the market just sleeps right through it. But this domestic dysfunction, as damaging as it is, it's not the main event. Not even close. The biggest risk, the one that could actually trigger a global cascade, is happening silently, halfway around the world. And that brings us to our final and honestly most critical clue, the Great Unwinding. You see, for decades, the entire global financial system has been powered by this sort of hidden engine, and right now, that engine is shutting down. It's called the yen carry trade. Now, I know it sounds complicated, but for a generation, it's been the source of what is essentially free money fueling global markets. The best way to think of it is like a giant financial fire hose, one that starts in Japan and has been spraying trillions and trillions of dollars all over US assets. Here's how it worked, and it was beautiful in its simplicity. For decades, investors could borrow money in Japan for basically nothing. We're talking near 0% interest. Then they take that free cash and buy US assets, stocks, bonds, you name it, that were paying them, say, 4 or 5%. That difference? That was pure low-risk profit. And this trade flooded the entire world with cheap capital, which pushed asset prices everywhere higher and higher. Well, now the game is over. Japan, absolutely crushed under a mountain of its own debt, is finally being forced to raise interest rates. In fact, their bond yields just saw the biggest jump since 1994. All of a sudden, borrowing in yen isn't free anymore. And here's the crucial point. To pay back those yen loans, what do investors have to do? They have to sell the US assets they bought. They have to sell stocks. They have to sell bonds. That fire hose of money, it's not just turning off, it's going into reverse. And it's about to start sucking liquidity out of the entire global system.
Look, understanding this global flow of capital, it's everything. It's the invisible current that really moves the markets. And honestly, it's why people stay with this channel. So, subscribe and keep tracking it with us.
So you see, these aren't three separate stories. They're not isolated risks that we can look at one by one. No, these are three massive tectonic plates grinding against each other, and they are set to converge at a single critical point in time.
Okay, let's recap. You have a fragile, incredibly top-heavy US market, you have a paralyzed government that's threatening to shut itself down, and you have a global liquidity pump that's shutting off as this massive yen carry trade reverses. All three of these fault lines, they all point to January 2026 as the point of maximum pressure.
And this is the catalyst. This is the event that's finally going to wake the market up from its long slumber. This convergence, this is what will finally pierce that veil of complacency and send the VIX, our fear gauge, screaming back above 20 as reality finally sets in. Which of course leaves us with the final question. What happens, what really happens, when a market built on just a handful of stocks, a government that can't even govern itself, and a global financial system being drained of its lifeblood? What happens when all of that collides at the exact same time?
Look, most people just watch the markets go up and down. This channel is for people who want to understand why they move. If you want to stay ahead of that curve, go ahead and subscribe.